announcements about future changes in consumption taxes to generate inflation expectations and hopefully accelerate expenditures, or forward guidance, namely the central bank communicating about the state of the economy and trying to influence financial decisions of households that way. And that holds, I mean, this importance for monetary policy definitely holds also during times of low inflation. So we pulled out here a Yellen, a Draghi, and a Powell quote, for example, the Powell quote from last year about inflation moving down, expectations moving down, and it's therefore being very, very hard for economies to get off the road once they're on that road, and he doesn't want to be on that road. Now, the problem is, and we are trying to use inflation expectations as a tool for monetary policy and for influencing the economy. The problem is that expectations are wild. So here's data from the New York Fed survey of consumers showing that, despite an inflation target of 2% and realized inflation recently consistently below 2%, we have huge cross-sectional dispersion. I mean, there is some mass around that 2%, but it goes, all the way to the right and far to the left as well. What has been less known until recently is that even within household, they're pretty wild. So we have another paper on gender roles and the gender expectation gaps with Francesco and Michael, where we look even within household how inflation expectations differ. And there's a systematic discrepancy between males and females. What is identified in that survey as the male and the female head of household in heterosexual couples, with women being consistently more pessimistic. I mean, both are too pessimistic, the expectations are too high, but there is a 2 to 3% difference between men and women. And where do these differences, even within a household, which is making a joint consumption and saving decision, where do these differences between men and women come from? Well, that leads us to the motivation for the paper today. If you zoom in to this kind of, on the left-hand side here, you see here the average gender difference in inflation expectation across all households, about 0.5 percentage points. You zoom in and you distinguish between men who are not doing any grocery shopping for the household and households where men participate in the grocery shopping for the household. You see that in the latter group, the difference between genders completely disappears. And then, of course, is even higher in the former group. So grocery shopping, exposure to grocery prices, which are known to be highly volatile, are even taken out of the core CPI for that reason. And we also know from prior research, people focus a lot on the increases, not the decreases, seem to be a major factor in explaining how household members form beliefs about future price movements. And that's what we take as the motivation for the current paper I'm presenting. You can, if you want to go a little bit back in history, also motivated historically, and put it in the context of Lucas's seminal island model, in which he posited that Asians use prices they observe in their daily lives to form expectations about aggregate inflation. Now, of course, he did not mean that literally, although we did look up that there was quite a debate about how that possible at the time, when people were more wedded to very traditional standard rational expectation models. But nevertheless, this idea that the environment we are placed in and the price signals we observe around us, the idea that that leaves a big impact on the beliefs we form, has not been systematically assessed in the field, and that's where we come in. Why hasn't it been systematically assessed? Well, I think one big hurdle has been the lack of data. You need data both on the expectations and on the prices households pay. And our step forward will be that we will be combining the Kills-Nielsen data, which was used in other papers presented today, in the first session today, with a new survey we fielded, and which we christened the Chicago Booth Attitude and Expectation Survey, in which we elicit expectations that we can then pair with these household grocery bundles. So to give you in a nutshell what the paper is about and what the findings are, let me first show you a question we asked in this survey, and then a relation with inflation expectations before I go into more details about that data. So one of the questions we asked respondents of that survey, which was again paired with the Nielsen data, is what for them is the most relevant source of information when forming inflation expectations, when we are asking them about the inflation expectations. And we gave them various choices, which you see listed here, some about other people, family, friends, a lot about media, TV, radio, newspaper, online news, social media, and then also shopping. And by far the dominant choice is own shopping. It is much more commonly the source of information people are thinking about when they're answering the question than any of the other options. And what we do here is basically to run with that and then say, well, let's see how prices in your shopping, specifically in your grocery shopping, which we can observe in the data, have moved over the past year for your household's consumption bundle and how it correlates with your stated expectations about future price changes. So here, it's again just the raw data. We are binning households into these 8 groups of price changes they've personally experienced in their household grocery shopping, from lowest to highest. And then we are plotting that, or we are showing the bars plotted against the average inflation expectation in that bin. And as you can see, without much econometrics, there's a clear positive relationship. And it is actually, in light of where inflation is today and in light of the inflation target of 2%, even quite sizable. So we see that the difference between the lowest and the highest portfolio amounts to 0.5 percentage points. And so what we do in the paper is go into more detail in documenting that, addressing possible alternatives, but also starting to think about mechanisms and channels. So let me give you a little bit more background about the data. So we know the Nielsen-Homescan database with very detailed UPC level information about the purchases, also some demographics, trips, the shops they're going to, etc. And then the Chicago Booth Expectation and Attitude Survey was fielded in 2 waves in June 2015 and June 2016. It was sent to all members of the Kiel's survey panel, and we got about a 45% response rate, which was quite nice. In addition to eliciting inflation expectations, we also elicited other expectations, for example, interest rate, income, employment, which we'll be controlling for, and we also elicited more household information, which is not available in the Nielsen data. And roughly speaking, we can think about the data we'll be analyzing as follows. There are these 2 surveys you see in the lower graph in June 2015 and June 2016. And we're going to look always what happened from basically 2 years to 1 year ago in terms of purchases that happened, prices of the bundles you bought, changes of those prices in the following period, what we call the measurement period, so for survey wave 1, 2014 to 15, to calculate the experienced inflation and then relate that to expectations. And then we do the same again in survey wave number 2, so measurement period 1 becomes base period 2, and then the year after becomes measurement period 2. So I'll give you more details on the exact formula in just a second, but let me just flag already now that the way we are thinking about price increases you've personally experienced in your consumption bundle is going to be in 2 ways. There are more we have explored, but I'm going to focus on the 2 key ones. The first one, which we call the household CPI, is basically mirroring the standard CPI we have, just on the household level. So we look at the proportion of your overall budget you're spending on each good purchased, and we're using that to weigh the price changes you personally experience in your bundle. Another one, and that's guided by some of the behavioral theories which are very much discussed here, relate to memory, attention, salience, etc., is what we call the frequency CPI. Instead of weighing by the expenditure share, as in the standard CPI, just household level, we're going to be weighing by the frequency of purchase. So there might be an increase of 10%, but for a very low-cost item like butter or milk, but you keep purchasing it, And so we want to test out whether that influences you more, that you keep seeing these price increases, even though dollar-wise, it's a small amount. So concretely, we are calculating here last pair price indices, where, for example, if I take my survey number 1, so I look at the base period, June 2013, May 2014, the measurement period, the year following that, and what happened to prices of the goods you purchased during that time. And I'm going to measure not only how much did the price change, so the delta PNIT, so the change in price for the good N, household I purchased at time T, weighted with some weights omega, which are N, so good, and I, household specific, divided by the sum of all weights. I'm not only going to do that for an expenditure share type calculation, so that's the second to last row here, household CPI. So there I use for the omega the PNI 0 times QNI 0, so the share in the original base period. No, I'm also alternatively going to use as my weights FNI 0, so the frequency of purchase in the base period. Here is how the distribution of these CPIs looks like. So the dashed line is that household CPI, and the solid line is the frequency CPI. And maybe in this way I'm plotting it here, they do look somewhat, quite similar, but, make no mistake, in light of, in particular, where inflation is at, those differences do make a difference. So the mean are sizable, I meant to say. The mean realized inflation in terms of household CPI is around 0.8%, while the frequency CPI gets you about twice as high, to 1.6%. And I should point out that food and beverage inflation during that time period was, higher than the core CPI 1.56 in 2015, but lower 0.71 in 2016. So it displayed this typical pattern of being more volatile, not actually necessarily higher. But again, here we are relying on, sorry if I can go back 2 slides, on this previous research, which has shown that consumers, when they're inferring prices from price changes they personally observe, they very much focus on the increases and put very little weight on the decreases. And we also have, specifically looked at discounts, etc., to show that those don't matter. Okay, so let me go to the baseline analysis here. So our key analysis consists of a simple regression that relates the expected price change, the household I states in our survey over the next 12 months. So T to T plus 1 is over the next 12 months, regressed on, of course, all sorts of demographics. That's the X prime gamma. You see it listed down there, income, age, education. I mean, we have a really wide range, and also proxies for risk aversion and patients from those various sources. Moreover, we can control for other expectations, income, economic outlook, financial outlook, which I'm separating out here as the Y prime gamma. Maybe shouldn't use gamma twice, but fine, so stack them. We are including county fixed effects, so that's the eta fixed effect. We're including time fixed effects, or survey wave fixed effects if you want. But then, of course, the variable of interest here is what I'm calling experience, or you could also use exposure in that case, pi I t minus 1 to t. What has the household personally experienced in their expenditures, focusing on grocery shopping, again, motivated by this survey evidence I showed you in the beginning. And I'm going to do this analysis both for the frequency CPI and for the household CPI. Here's the result. I'm going to go through key result. I'm going to go through it in 3 steps. Household CPI is highly significantly predictive of your expectations. This 0.17 coefficient doesn't change if I include more and more controls. It gets, if anything, slightly higher if I even put in individual fixed effects, or household fixed effects if you want, which I can because we have 2 waves. Sizable, 1 standard deviation higher observed price change means that I expect inflation to be higher, 0.2 percentage points. Similar results if I use just the frequency CPI, somewhat higher, 0.2, and with fixed X 0.3. Interestingly, if I throw in both, you see that the frequently CPI is really driving the association with expected inflation. So not the standard expenditure weights, but based on frequency. I want just to show
Ulrike, roughly 5 minutes.
Okay, yes, I can definitely make it. So a few variations on that. One question we immediately asked, and we've asked in much of the previous research on experience effect, is that just something the unsophisticated, uneducated person does, or does that also hold for more sophisticated individuals? What we have here in the data is based on information on education. Did you have a quantitative major? Then we tried out, I mean, maybe I've worked too much on mortgages, but like mortgage holders, because they must have thought about, interest rates. And then in prior literature, people have pointed out that the propensity to round your expectation is a sign of uncertainty. So if I split the sample into quantitative major, no, yes, mortgage holder, no, yes, rounder, no, yes. Well, you do see that if you want to take these as proxies for sophistication, I want to be quite frank, there's of course other stuff going on. If you do want to take those as proxies for sophistication, it goes in the expected direction that the more sophisticated guys, shown in red here, have a lower effect of exposure translating into your stated beliefs, but it is significant and it is there also for them. So that's one first interesting takeaway. Then 3 more variations in terms of trying to start getting at the channel of what I'm showing you here. First one is, does it matter if the price change is larger in any direction? So kind of salience memory models would say that. And what you can do, for example, is look at price changes in terms of percentages to the frequency-based measures. So you take out the dollar amount you're actually using, and then you're putting the whole data into kind of terciles of bottom decreases or like decreases, intermediate changes, and top changes. And is indeed, the reaction is indeed driven by larger price changes, which seem to stick to your memory. Second result, consistent with that, a person who goes shopping every day should maybe see not so many price changes, right? From one day to the next, things are pretty similar. A person who just goes once a month to Costco, or in these days, like maybe even more rarely, is more likely to see bigger movements and should be more affected by those changes. It might be easier to recall these price changes, for example, if you want to give the thing a memory frame. And indeed, that does seem to be the case if I'm a person who doesn't go frequently shopping, I'm not the primary shopper, my frequency is less than 1 a week, or the distance to the outlet is pretty far, more than 60 miles. So the items I buy there, I probably don't see the prices often. The effect sizes we estimate are even larger than what I showed you before. So that's, again, consistently with big changes sticking to your mind. And then the last one is, while we're focusing here on grocery prices, which we do think are crucial because we're exposed to them so much, and while one might make sense to take them out of the core CPI to detect, inflation trends, but it doesn't make sense if you want to understand people's thinking. So while that's the emphasis here, we don't want to say other prices don't matter. I dream of the day where I get Google to do a Google Glasses data set experiment with me. I can see every price signal that people observe while walking around. But as a crude first proxy, for example, in our survey, we have information on how frequently people go to gas stations. And if that is particularly high, then that effect starts kicking in and the grocery price effect is lower. Same if I go frequently to restaurants. So let me, I think just on time, conclude. The main message we want to convey here is that as we're thinking about people, how people form beliefs, we need to get a better handle on the environment they're living in and what they observe around them. Not just is that theoretically the most important information, what I read on the last page of The Economist, that will affect me, but I would be hugely underestimating the dominant factors if I left out the rest. It is the frequency CPI, not the expenditure weighted CPI, that's driving these results, and the result is stronger for larger relative price changes, less frequent shoppers, and shoppers mostly exposed to groceries price changes, which we are studying here. Bottom line, while we don't have a complete theory for this, it certainly relates to prior work I've done on experience-based learning. We hope that all of these facts help inform theoretical work and maybe experiments to pin down the channels further. And with that, I'm done. Thank you.
This is joint work with Ralph Koijen, And it's so-called in search of the origins of financial fluctuations, the inelastic markets hypothesis. So the key question is, why financial markets so volatile? And there are modern asset pricing theories with time-varying risk aversion, time-varying macroeconomic risk, changing beliefs about fundamentals. But it turns out in all those models, there's a big common feature that's problematic, is that markets are very macroelastic, by which I mean, if I buy 1% of a market, a very small little 1% of the market, prices will move very little in those environments by less by 0.1%. Okay, and that's because everybody else has strong beliefs about what prices should be, and the prices deviated from those beliefs, boom, they would be pinned back to the perceived value, fundamental value of the stock. And so we're going to tell you this is not correct. And actually, we're going to propose an alternative complementary view that markets are actually very macro inelastic, by which will mean the demand elasticity for stocks is very small. And the mirror image of that will be a small shock to buying demand in the stock market. Buy a little bit of stock, selling a little bit of bonds, will have a big impact on the stock market. And so that's an important feature of what's price drives fluctuations, is this extreme reactivity of prices to apparently little flows, and we call that the inelastic markets hypothesis. Flows affect market prices and also expected returns in quantitatively important ways. So, so it raises a number of questions. Some a priori reasons. So you see a little bit the physical picture of the world, the intuitive picture of the fundamental forces of the world as we see them in that perspective. Is that people who trade stocks tend to be very constrained, either by self-imposed constraint or by constraints imposed by their clients. So many funds are completely constrained. So typically, often they're exactly 100% in equities. So that if I want to buy $1 worth of one share, selling $10 worth of bonds, they can't give me their share because they can't accept the bond. They need to stay 100% in equities. Or there may be 70% in equities. They're still extremely constrained and they will provide very little elasticity to the market. And what about some more agile players like hedge funds? They're actually very, very small. They manage maybe 5% of the market. And actually in downturns, they need to reduce their exposure. So they don't provide enough elasticity. Also, if you look at, I'll show you some graphs, flows across different investor sectors like hedge funds and consumers and pension funds, etc. They're extremely very small. There are very little equities that flows from one segment to the next. Again, consistent with demands that are being extremely sluggish. Okay, it's about 0.5% per quarter, very small. And also, there's a more fancy evidence from like the micro elasticity, but like don't worry about that. So now, why do we care? Is that as a result, flows, if markets are indeed that inelastic, potentially small flows will be very impactful. And we find that maybe at least 1/3 of stock market fluctuations are driven by those flows, and potentially much more actually. Okay. And it kind of replaces the dark matter of asset pricing, where you say, oh, there's expectations about long-run growth that are correct or maybe not correct, etc., with very tangible flows and demand shocks by different investors. And you can see, who was buying in 2000, who was selling in 2008, who was selling in 2020, etc., etc. And several questions that are just completely irrelevant or uninteresting in traditional models become really interesting. Say government interventions in a world like that. Government interventions have big impacts potentially, and you can do quantitative easing for equities. It turns out to be much more powerful in our calibration than quantitative easing for bonds. Okay, so how elastic is the market? So we have an IV strategy that I'll explain. It's called a granular IV, and we developed it especially for this paper, but it's now a standalone paper, and it's for the big empiricists out there. Here, even if you don't care about the stock market, this IV strategy, I think, could be really useful in a number of settings. And the rough idea is we need to look at idiosyncratic shocks to some of the major players in the stock market, big hedge funds, big sectors, big institutions, etc. And their idiosyncratic shocks, they're kind of orthogonal to everything else primitively, but they're still going to affect everybody, the prices and everybody's quantities. So there will be instruments to see how prices and quantities move. And that's going to allow us to recover elasticities of supply, elasticity of demand. And that's generally applicable in many markets, you know, oil markets, bond markets, exchange rate market, lots of markets. Anyway, so what's the punchline? Empirical punchline. It's if I buy 1% of a market, okay, so I sell bonds, let's say suppose I buy $1 worth of shares, selling $1 worth of bonds. Then first, in a super rational model, nothing should happen. Prices should be at fundamentals and okay. But in fact, prices will go up in our world by about $5. So the stock market is this, you know, very active machine where I inject $1 in the machine, boom, the machine goes up by $5, you know, so to speak. And it's symmetric for buying and selling. And by the way, it seems like a very permanent price impact. It's not like short-term thing. It doesn't seem to mean revert, at least at observable timescales. And the model calibrates with micro data. So I'll talk about the aggregate, but also we think about the you know, micro behavior of each participant, and it seems to calibrate actually quite well. Okay. Okay, so let's look at some data. So what happens in a big downturn? So this is the 2008 downturns. We looked at the 2001. It's very much the same picture. So it's primarily the household sector that sells equities to buy bonds or cash, something. By how much? It's only 0.5%. You see, the total flows are actually very small, 0.5% in a very major per quarter in a very major downturn. Okay, and many people are just completely inert. And then who buys? It's actually the pension funds, and you see, it won't be a fluke because they're very rigid in what they need to do. That's why they're kind of forced to buy, and actually the foreigners. Okay, also by very, very small amounts by market clearing, 0.3%, something like that. Okay, so small flows even during very, very, very big price movements. And now let's look more directly at what's the, so this graph tells you the equity share. Okay, so suppose your stocks and bonds. This paper is all about the aggregate equity market, not about Apple versus Amazon. It's all about aggregate equities. So suppose you're a typical mutual fund. Your average equity share maybe is 90%, and it's very flat 90%. From 1993 to now, it's very flat. You know, there were huge ups and downs in the market. They still, and we think by mandate, they have to stay at that, you know, target allocation. And they basically don't really want to deviate. As a result, if prices are really off, they will not be able or willing to you know, buy and sell shares because they need to stay at that target. Oops. And if you do ETFs, exchange traded funds, same thing, state and local pension fund, extremely flat also. It's a big segment of the market, okay? So imagine this picture of a market. Institutions are very, very rigid. They have fairly tight mandate, and they cannot really buy equities to sell bonds or vice versa. They can trade Apple versus Amazon, but not the aggregate equity market against the aggregate bond market. As a result, the aggregate equity market could be very mispriced because very few people are there to kind of try to correct it. Okay, so let's do a model now of that. So we have a two-period model. So there's a fixed number of shares, fixed number of bonds. And there are two, you trade not directly, but via two funds. There's a pure bond fund that just holds bonds. And there's a balance fund that has a mandate. And the mandate of a balance fund is, on average, you should have exactly a fraction theta in equities, but you're a little flexible potentially. If the equity premium is higher than average, so expected equity returns are higher, you're allowed, actually you're mandated to buy more equities by this parameter kappa. So kappa could be 0, then you're completely fixed. Kappa could be strictly positive, and you provide a little more leaning against the wind. Okay. With rational consumers, those mandates would not matter at all because anything that the mandate does, the rational consumer could undo it. But our consumers will not be fully rational. And then we ask, suppose there's, I'm going to simplify a little bit the slides because of lack of time. Suppose somebody comes in and buys 1% of the market. What happens to the market? The average equity price is going to go up by the 1% over zeta, where zeta is the macroelasticity of a demand for stocks. Okay, and it's made of 1 minus theta, that's the average equity allocation. And then if you do react to the risk premium, it's a little higher than that. So quantitatively, it's a very small effect. And what's going to calibrate and estimate is that this zeta is around 0.2, okay? Which means that, given it's 100 zeta that matters, if I sell $1 worth of stocks against taking out $1 worth of bonds, the whole market will fall by 5 times that, so $5. Okay, so flows will have very, very big impacts. We also generalize to infinite horizon. It's exactly the same thing, but it's just some sort of present value, myopic present value that that happens. Okay. By the way, so in the naive efficient markets where prices are always equal to fundamentals, you'd get M equals 0. We also polled actually economists at 2 seminars, okay? And they have a typically efficient markets intuition. They think that if I inject $1 in the market may go up by at most 1 cent, okay? But in fact, if our results are true, the median belief by economists, professional economists, is off by a factor of 500. So we correct people's beliefs, if we're correct, okay? We correct the median economist belief by a factor of 500, which is useful. Good. So you can calibrate that. Basically, that's the expression I showed you. You also want to have some inertia or full inattention. You just buy and hold. And then you look at the average equity share maybe of 85%. And then you look at how forward-looking, how people react to the equity premium. And we have some thought experiments and actual calibrations. It's something like factor 1.5, which you can't directly interpret. Anyway, this way you can easily account for an average elasticity of 0.2, and there's a series of thought experiments. Anyway, so how do we do that? So we developed. So how do we estimate that? So you can do OLS, and it's kind of interesting, but we do an IV. And so the idea, we developed this granular instrumental variable. So I give you a crash course in them in 3 minutes. Okay, so how does it work? So we need a number of institutions. It's enough to have like more than 3 or 4, but in practice you have 10 or 1,000 institutions depending on the data set. And this is the demand change of institution I, or will depend on the price change P times some elasticity which we want to measure. And then there's some idiosyncratic shocks, and then also some aggregate shock eta. Okay, and what we're going to do is, by market clearing, the price of equities will react to the size-weighted idiosyncratic shocks for equities. And this granular view, in part of it, is saying that a lot of the fluctuations in the aggregate economy, they're due to idiosyncratic shocks to large players. And here is going to be large hedge funds, large institutions, large advisors, large, mutual funds, and their idiosyncratic shock, demand shocks for equities are going to materially affect the aggregate price of equities in this very reactive inelastic market. So imagine we manage to extract the idiosyncratic shock institution I, at least for a bunch of institutions. What we're going to do is form the size-weighted sum of those idiosyncratic demand shocks, and that will be some aggregate idiosyncratic demand shock. Okay, and then as a theorem, we can regress the change in the price on this size-weighted idiosyncratic demand shock, and that's going to give us a legitimate, consistent estimate of this market elasticity. Inverse elasticity is the market multiplier. And how do we estimate the idiosyncratic shocks? We run a factor model, basically, and there's a 40-page of proofs and variants in the other paper. When we do that, so we regress the change quarter by quarter, the change in the aggregate equity price on the size-weighted idiosyncratic demand shock, we find a multiplier, around 5. That's my 5 here, and we do a bunch of controls. And by the way, on impact, it's a multiplier between 5 and 7, really. And then it seems very permanent. Again, there's a permanent increase in the demand for equities, so that permanent change in the price of equities. And we do tons of controls, and because we're anxious. And here's something you find. So here in green, you have a cyclical flows, After the flows have been positive, the market has gone up. After the flows have been negative, the market has gone down. And it goes completely in tandem, in some sense, as it should, okay? You see that and with the correct elasticity. Compared to Andre's beliefs and all that, flows are very competitive compared to beliefs. Let me just...
Xavier, I think you're well aware and you're doing well, and you have about 5 minutes.
Thank you very much. That's great. So, okay, so let's imagine this view is correct. So what do we do with it? So there are policy implications. Let me just sketch them. If I'm the a variety of Asian governments, they bought, say, Hong Kong, they were under some speculative attack, they said, let's buy 6% of the market. You know, elasticity, market multiplier of 5, it would mean the Hong Kong stock market would go up by 30%. And it did go up actually by 24%. There's no identification there, but it's kind of interesting. And then Japan, China have been doing that. And it could be a very valid policy. The multiplier for bonds is more like 1/3, where for stocks, it's more like a multiplier of 5. So it's a much more effective to do QE for stocks than for bonds. You can do corporate finance in elastic market. So if we aggregate corporations, or in the aggregate do share buybacks, in the rational model, nothing happens. But in our world, prices of equities will go up, like a naive undergraduate or MBA would think. You know, if corporations buy shares, shares go up. It should not be the case in a rational model, but it is the case here. By the way, in Andre's model, it would not be the case either. But anyway, okay. So we try also to endogenize flows. Okay, and let me tell you a little bit. So, because we still want unification of macrofinance with some relevant behavioral elements, we also have a whole Lucas-style general equilibrium, actually also Mike-style model, okay? So it's all GE with production and all that. And we do macrofinance with flows. And so I give you just some elements. So there's a household, a representative household. There's a rational consumer who trades his consumption rationally. He just trades the bonds, okay, the rational consumer. And as a result, the Euler equation still holds for bonds, just for bonds. But there's a behavioral investor in the household, and this one just try to maximize some sort of risk-adjusted return on equities, okay, using narrow framing. So an important behavioral idea that here we use. And that's and has on average pretty rational flows, like in the long run, the flows are rational, but there are lots of bumps in that. And that's what creates those bumps in the persistent bumps in the inflows, create shocks to the inflows and then deviation in the stock market. The model matches all the key moments of stock volatility, predictability, and all that, and all the macro moments, including, you know, risk-free rate and the bond market and all those things. And it's designed to mix well with like rational macro a la Kidd and Prescott and a la Mike with New Keynesian thing, and also more behavioral macro like some of the things I've developed. And you can also do production. So in particular, you can trace. Suppose people for some reason want to buy more stocks, the price of equities goes up. As a result, firms want to issue more equity and do more investment. As a result, investment will go up, wages will go up, and GDP will go up. And you can do that in a tidy, consistent package. So we think it's useful to have that object on the table. And a big difference compared to other models with stock fluctuations, excess fluctuation in the stock market, is that you can trace back the dark matter to very tangible flows. And like in the 2008 graph I showed you, you can see who was buying in 2008, who was selling in 2008, but who was buying, because somebody must buy. It was the pension funds. And that can, you know, build rich theories of what was their beliefs or their constraint and all that. How do you generate slightly more abstractly those very small macro elasticities? So one is for more general behavior. One is just inertia. Many people are just buy and hold. I don't touch my stocks and my bonds, so in my stocks, and as a result, they provide exactly zero elasticity. Others have a mandate, like keep a fixed 20/80 allocation, and then you create an elasticity of 0.2. We think it's the essence. You have the more like trend followers, momentum traders. They provide a negative elasticity, so they lower the average elasticity in the market. And then you have a rich literature on stated beliefs and what happens to them, and they don't seem to translate very much into very big actions. And so models of inattentions, low pass-through to beliefs, and also low pass-through from reality to beliefs and low pass-through from beliefs to actions, models of inattention being super rational or more behavioral, are right there ready to be calibrated for that if you want. So let me conclude. So markets are very inelastic, contra Lucas model and contra even behavioral model where people have beliefs and they think the market should be priced given those beliefs. Central to this physical view of the world, intuitive view of the world, and an actual model, it's big inattention by investors to various things in the markets and rigidity by institutions. And so investors don't correct the institutions and vice versa. And the implications you can do, first, maybe you can understand better what's going on in the stock market. People sell boom, the stock market fall a lot. And you replace all the dark matter of change in expectations or change in risk aversion by very tangible flows. You can see who was moving quarter by quarter, which is pleasurable. And then you can investigate perennial question, who was doing that in this or that quarter, the source of market volatility, and potentially you can think about policy like government interventions and the like. And in general, it's part of a micro to macro where you inform your macro model via micro data on who does what in terms of buying and selling in the stock market. Thank you very much.
So let me begin with a few words about the topic of this session, which is boundedly rational expectations in macro. I think it's safe to say that a large swath of macro can be characterized as good people, bad outcomes. This research takes the aggregate behavior as the source of all inefficiency and treats individuals as rational. Now, this creates a huge opening for to apply research on attention, memory, and perception to macro questions. And each of these papers takes a step in that direction. I've created this Venn diagram to organize my thoughts about the overlap between the two papers. The intersection shows the areas of commonality. Topics, questions, approaches, empirical. I mean, I could have used this. They do share some of the same pronouns.
They share the same discussant.
That's basically it. Actually, I came up with interesting and provocative as the only source of commonality. I'm not as imaginative as Dimitri, who strung together a fairly coherent discussion. So I'm going to talk about each of these papers separately and begin with DMOW. So the topic's inflation expectations. And these are important because inflation expectations are believed to be the primary driver of inflation. Most of our models, especially the new Keynesian model, inflation expectations is the most important driver of inflation. Now, if you chat with Federal Reserve board members and ask them what their theory of inflation is, a modal answer will be that inflation is equal to expected inflation. So the topic of inflation expectations is central. Now the question that they ask in this paper is, does the shopping experience of a household help explain the cross-sectional heterogeneity in inflation expectations? So, and the answer they come up with is a resounding yes. And this is important because it's indicative of some sorts of information frictions. I mean, if everybody had access to the same information, you would expect them to form the same expectations. So either they're seeing different things or they're processing this information differently, but there's something going on between the world and their brains that is creating heterogeneity in what they believe will happen in the future. So basically what they do is they collect a bunch of data. A bunch of data was collected for them by Nielsen, but they add to this some survey data on inflation expectations. And the goal is to see whether the shopping experience from Nielsen is predictive of the elicited inflation expectations. So how do they quantify the shopping experience? They boil it down to a single statistic, a version of the CPI. So if you look at the equation here, the sum is over goods. N goes from little n to big N. And then we have the change of the price for each good for household J at date T. So this is T minus 1 to T, past to the present. And then you have some weights. You're going to weight these price changes by a weight. The weight's going to depend on the good, N, and the household, J. Everyone gets their own weight. Every good gets its own weight, okay? Now what they look for is they look for weights that kind of help explain expectations. And they search over a large number. 3 that work particularly well are expenditure. That's the traditional CPI. You expenditure weight the price of goods. The quantity purchased, dropping the prices, just the number of goods purchased, that's what they call their experience CPI. That's their favorite. And then just the number of trips also works well. Like how many times do you buy the good? Works pretty well. But overall, this is the one that seems to dominate. The quantity of goods purchased they all have similar R-squareds, but you put them in a horse race and the quantity seems to dominate. Okay. Now, the paper, goes into great detail. There's a lot of robustness. It's overall a very convincing study. There's very little to say, to criticize. I guess if there's anything that I was left wanting a little bit more. And my 2 comments on this paper are essentially going to be what I was left wanting more of. So the first one, which Ulrike kind of mentioned in her talk, is they never really settle down on a theory. They come up with a lot of fascinating facts and characteristics of how these experience-weighted CPIs work. It's quantity, not expenditure, positive, not negative, large, not small. But when you start thinking about theories, it's kind of tough to fit some existing theories into these results. For example, rational attention models would tend to emphasize the gain to paying attention. You would think that would depend on prices in some way, because prices are marginal utilities and marginal utilities are welfare. And so why does Q work better than expenditure? That's one question. Signal extraction models would tend to focus on the frequency of interaction. That would point to the number of trips, not the quantity purchased. And so it seems to be some complicated story that if you go too often, the price changes are too small. If they're too small, you don't notice them. And if you buy more, you do. And finding a theory that kind of explains all of these things would be kind of helpful for the reader to have a place to put all these results into boxes. And right now, there's just a scatter of results that are crying for a unifying theme. The second thing, my second question that I kind of wanted to see more in is, and you think about what you would have done if you had written the paper, and that's to relax the dependence on the CPI methodology. For example, this is a prediction exercise. It's not a cost of living calculation. And so maybe people form expectations in a different way than the CPI is constructed. For a simple, straightforward one is why use period T weights? Why not use period T weights? They use their base year is the first year, and then the price changes are from T minus 1 to T. But you're forming your expectations in T. So isn't your shopping experience in period T the one that matters, not the experience in T minus 1? Or maybe it's some combination. You see it in both periods, T and T minus 1 that matters. Second, why use the same weighting scheme for all goods? I can think of goods like milk I buy all the time, but the kids only drink one kind of milk. And so I pay no attention to the price. I go there, I put 4 pints of quarts of milk in, and then I buy it. Whereas other things I buy all the time, like wine, I'm kind of look through, what do I feel like today? I look at the prices, I pay much more attention. So different goods might have different ways to weight. And I think there's a missed opportunity here, and that it's a prediction exercise. and the machinery that's just built for prediction is machine learning. Like have some, you know, neural net trying to figure out what the optimal weighting scheme is, and then look at those weights and say, what are the characteristics of these goods that are leading to high weights or low weights, and then try to back out the theory from that. But it seems like, you know, let the data speak on what the weighting is rather than trying random weights. Would have been a fun exercise, and something that could be done. They have all the data. They have 50,000 observations. Machine learning loves that, and it's kind of sitting there. That's all I had to say about DMOW. Excellent paper, provocative, loved reading it. Let's talk about GK. Now, the question here is completely different. What's the source of the volatility in the stock market? And the traditional answer, as Andre said, is the volatile stochastic discount factor. GK is not going to focus on expectations. They're going to look at inelastic demand for stocks, and that this magnifies flows into and out of the market. Now, this is a truly massive paper. It covers a lot of ground: theory, empirics, advertising, philosophy, little religion thrown in. There's no way to do it justice in 5 minutes. I don't even know if I have 5 minutes. But so what I thought I would do, which I was really counting on Xavier to try to explain the whole thing in his 20 minutes, is just to explain the core idea and what it's all about. And then you can form your own view on whether this is a good idea or not. Okay. So let's consider a stark setting. You got a stock market. And this stock market is dominated, and that word's key, by a fund that holds 40% of its assets in stocks and 60% in bonds. By dominated, I mean there's just not a lot of to be dominated in two ways. They could be the whole market, or there's just nobody out there everybody else's demand is so inelastic that there's no one out there really trading with this guy, right? So this guy's basically, consider it like buying the whole market. Holds 40%. This is kind of an inelastic decision rule of what this fund is going to do. And so it's not going to really be very flexible on how it allocates its assets. Suppose bonds are in perfectly elastic supply, internationally traded, whatever you want. There's somebody out there who's always willing to buy and sell bonds. They relaxed that in the GE model, but for the simple example, it's much easier. Suppose the fund holds $100. That's because I like round numbers. And consider what happens if an agent places $10 into this fund. Okay, that's the exercise. Now here we have the initial condition. The fund has $100. On the left, you have your stocks. I've normalized price to 1, so there's 40 shares, $40 in stocks. And on the right, you have bonds. I've normalized the price to 1. You have 60 shares or 60 bonds, and that's the allocation. Okay, now we're going to put $10 into this fund. The fund's going to want to buy $4 in stocks and $6 in bonds. That's what it wants to do. Now in the traditional model, everybody's on their Euler equation. So they're indifferent between investing in any asset. And if the prices change a little bit, people are willing to shift, you know, away from the higher price asset and towards the lower price asset. So there's someone willing to supply the 4 shares that the fund wants. So the fund's holding rises. We go from, on the left there, you see from 40 to 44. Price rises infinitesimally above 1 to encourage everyone else to supply those shares. And then remember, bond supply was elastic, so they can buy the 6 shares of bonds. Fine, all well and good. Not in Xavier's world, though. Here's what happens there. Supply, I say supply is inelastic because supply is other people's demand, right? You get bonds by selling them or buying them from other people. If other people's demands are inelastic, their demands are your supplies. So in the extreme case, nobody's willing to trade with you. And all the shares have to be held by this fund. So that the fund can't increase from 40 shares. And so the price has to go up. In order to hold $44 in stocks, the price jumps up to 1.1. And it can easily buy the bonds on the right. It has 66 shares of bonds at the price of 1. Okay, that would be what would happen if you didn't solve the model correctly. We're not done, because that rise in price on the left from 1 to 1.1 is a capital gain for the 40 shares the fund already held. So it's as if another 40 times 0.1, 1 to 1.1, flows into the fund. But then we have kind of a multiplier. It's a little bit like the fiscal multiplier in undergraduate macro. You spend it, government spends $1, it's $1 of income, people spend 60 cents, that's 60 cents of income, people then spend 36 cents, that's 36 cents of income. Same thing happens here. We put in $10, but now another $4 flows into the fund through capital gains. You run the multiplier and repeat to convergence, and instead of the price going up from 1 to 1.1, it goes from 1 to 1.67, and they end up holding almost 70 shares of the bonds. Now, a key parameter here is this 40%. If you look up there, the multiplier, what flows in is 40 times 0.1. If this fund had held 100% of its assets in stocks, then it would have been basically 100 times 0.1, and it would have been another $10, and the multiplier would have been infinite. So they can get any number between 0 and infinity with this model, well, actually 1 and infinity with this model, depending upon that 4066. I think Xavier had something like 0.82, 0.85 as the number, so it's a pretty big multiplier. Now, they also add a little bit of price sensitivity that reduces this multiplier, but that's the basic idea of how inelastic demand can lead to feedback, so that $1 invested has a price in a 1% increase in investment can have a price impact that's a multiple of 1%. This has lots of implications. Flows matter, potential for long-lived deviations from fundamental value. There's nobody acting to arbitrage this. It's in that limits to arbitrage literature. Failure of Modigliani-Miller, failure of Ricardian equivalents. Big players aren't going to take prices as given. I mean, if you're a big player, you're going to be somewhat of a monopolist. You might put your money in slowly in order to get some of those capital gains yourself. Or you might not completely arbitrage the market in order to leave some returns on the table for yourself. You're like a monopoly. It's not a price-taking investor anymore. So it's all interesting and fascinating. The big open question is why demand is inelastic. I mean, they basically take this as a hypothesis and as something that's observed in the data, and then run with it and do everything they can to figure out what its implications are. But the exactly why people are inelastic is in some sense the big ask I would have for this paper, and anything Xavier has to say about what that is, I would be very interested in. But both of these were really interesting, exciting, and I want to thank all the authors for getting me to read these two interesting and potentially important papers. Thank you.
I should be speaking and saying thank you very much. I think the next thing is for Ulrike and Xavier to respond to John, and then we can turn it over to the floor. And I have Dimitri will pose a question. I've seen him as the first after that. Thanks.
Ulrike, go ahead. Yeah.
Yeah, well, thank you so much for reading these two papers and for the fantastic feedback. On those 3 points, I mean, basically, I completely agree. We went into that thinking about different possible theories, and to some extent got stuck or held up by just kind of showing this baseline fact, the environment you put a person into and the price signals it generates around them has this strong impact, which isn't just your usual information friction, the one we have in your usual traditional models. And so it turned out that we needed to establish that and distinctions from variants of the kind of the rational existing framework is kind of what we needed to tackle first before we could go to the mechanism and underlying theory more deeply. But we are very much thinking about where does the quantity positivity large effect stuff come from. And I think like your two suggestions are interesting because we came very much from, let's think about theory, and then instead of like testing around various variants, like test exactly that. But you're saying, well, kind of could approach it the other way around, you know, throw machine learning at it and kind of let it tell you. And I'll definitely discuss that with my co-author. That's a great suggestion also. Thank you.
Great, and thank you very much, John, for this, as always, amusing and enlightening discussion. So why is the market so inelastic? So first, almost institution by institution, we see what they do, and many are just completely constrained. So 100% equity mutual fund cannot do that. 80-20 mutual fund can only provide a 0.2 elasticity. 80% equity is 20%. So they're very rigid. Now, more deeply, why is it that institutions are fairly rigid mandates? And then you go into a complicated mix of principal agent asymmetric information, namely, do I want to tell my fund manager, do whatever you think is good? Because maybe this person is really good, or maybe he's not, or maybe she used to be good in the past, but maybe she's not good anymore. So it's very hard to know. So maybe I want to constrain my agent towards meaning my fund manager towards something a little conservative and predictable and something you can back test, for instance. And now, why aren't investors themselves, the individual, if my institution is inelastic, maybe I should. And then also it's a mix of, so right now in the actual model, we say, inattention to fundamentals in the stock market, but not fundamental, rather to reaction to behavioral deviations. But it's, we can all pour in our own souls, in March, you're not selling the stock. The stock market kind of looks overvalued, frankly, now. Most of us, I think, are doing exactly nothing about that. Why is that? Is it, regret aversion, or, there's a default? It's very hard to deviate from the default without a good reason. We want to justify ourselves, or so right now it's just under the umbrella of, it's hard to have good signals by the market, so you react very little to them. But there's this evidence by Giglio Maggiorino that even given people's stated beliefs about the market, they underreact a lot by a factor of maybe 10 or 20 to them. So part of your mind has some views of the market, but the decision maker in you doesn't really listen to the economists in you, Anyway, lots of good things for future research. Now we have a dogmatic way to, bottle it up in the model, saying there's, various, inattention to this and that, but the deep macro foundations of that would be very interesting, but they would take, 10 years or more. So we can't wait. Thank you.
All right, so Dimitri has a different question for Ulrike, and I think that's the one I see on the chat. And anybody else who has a question, please chat it, or in fact, you could record it in the Q&A and I'll find it. Dimitri?
Yeah, well, Ulrike already wrote very detailed answers to
I see.
all of the questions.
They went to
just let
Dimitri privately. Sorry, the default was not to share it with everybody. Yeah, but if you want to quickly chat about it, Dimitri.
Yeah, but Ulrike, maybe you can just choose whichever one you think is kind of good for public.
I think they were all good for public knowledge. So let me maybe just summarize. We went a little bit back and forth. So first of all, Dimitri was asking about the rational benchmark. And that's kind of similar to the first answer I had for John. In some sense, we are a step before, kind of pointing out all sorts of aspects in terms of, the quantity matters and the positivity matters, etc., to kind of distinguish it from a typical information friction in a standard model, and not exactly able to contrast that's the rational benchmark versus not. But that's, something we are careful about now, but are very curious about. Specifically, Dimitri pointed out, well, given that you're observing grocery shopping, And I would add, like, we have good reasons to focus on grocery shopping because we've seen how relevant that is, for example, for the gender expectations gap. But that's not all the shopping. And in your survey, they answered that, you know, their own shopping matters, not just their own grocery shopping, which is exactly right. And in fact, you know, Dimitri was suggesting that should lead to some attenuation, so your effect is even stronger, so to speak. So I would put it, I guess, in terms of R squared. You know, if the prices they do go around, overall price increases, you know, we might even get the usual coefficient, but you can't expect us to have a super high R square, or you may want to multiply it. You know, if that's 25, 30% of expenditure, you know, you want to scale it up. And that's exactly right. And as I said before, I would just love to have that data set that, you know, gets me all the price signals I see all day long. And then it's really interesting to think.
So on the magnitude question, but are we really in a world where we just have a completely uninformative prior about what that coefficient should be? If people were like, is there a sense in which we can at least obtain like a ballpark for saying like, wow, that coefficient is surprisingly large, or why is that coefficient so small? Maybe attenuation is playing an important role here, or like, are we really just in a completely uninformative prior world right now?
Well, I found it surprisingly large, but how do I justify that? You know, it really depends on your benchmark model, though, right? Like, what, based on what do you form your expectations? So I have a hard time giving you a number. I don't know, John is unmuting himself, whether he has a view on,
no, just like taking the prior as being full information, that everyone has the same information, the coefficient should be 0 because it all be netted out by the time effects.
Yeah, so that's
just
exactly
showing,
the perspective.
You know, significant, you know, local information. I think that's important in first order, and it's highly significant.
Yeah, no, that's exactly our perspective. But then, of course, it would be lovely if I could say, well, even if you take these reasonable assumptions about information frictions into account, where still everybody's rational, you add some bells and whistles to the more traditional models, you will get X. And we are basically having the 0 and benchmark. And, you know, sure, you can push it maybe a little bit with information frictions. I did want to also briefly say, kind of, you were asking about, well, where does this variation in experience inflation comes from? Are there cross-sectional differences in your households you're not accounting for example? And, you know, one simple answer was, of course, to say, well, remember, like, if I put in household fixed effects, if anything, the coefficient is larger. So I think that's quite helpful to kind of address alternatives. But I also wanted to just quote this paper by Greg Caplin and Moritz Schulhofer-Wohl, where they have, that's a slide I'd cut out, where they have a recent JME paper where they show that, in fact, there is surprisingly large cross-sectional dispersion in realized shopping bundle inflation, which is what is this graph. So their interquartile range in their paper, 6.3 percentage point, and they argue quite convincingly that the differences in prices paid drives the dispersion, not actually the goods purchased. So that is kind of interesting to see that there is this variation in like holding constant the good you're actually looking at. So sorry, let me unshare again. Just wanted to kind of quickly show that. I think that covers it all. And thanks for the feedback, Dimitri.
So Xavier, what would you cite? So what would you cite as the evidence of the type of inelasticity? Would you say the right way to do it is to read the constitution of an investment fund, and you just go, I'm just going to read it, and I'm going to look at that, and
no, you just look at their action. I mean, you can do that, but even better, just look at what they do. So remember early on in the talk, I presented a graph with 3 little lines. And that was what that was the average, say for mutual funds, that was the average equity share, and it was equity weighted because that's what the accounting and everything wants. And that's very stable. So first we started just looking at the world with our own eyes. Many mutual funds, it's 100% equity. So they can only provide exactly 0%, zero elasticity, because they cannot hold bonds for any period of time.
But you wouldn't look at, you know, at P times Q being constant in a set and saying, you know, it's a Cobb-Douglas utility function, so P times Q is constant. You don't go from the fact that some expenditure is constant to the fact that it's rigid and you would never have changed.
No, but I mean, I invite you to look at the paper. It will be a bit, but it's just under, you see, the equity premium.
But yeah,
varies a lot
just
in
to
that
be
sample.
solid, Xavier, you are arguing that there is evidence that it's rigid.
Yeah, very, very evident.
Okay.
So for many funds, just exactly at 100%, you know, plus or minus 1% of cash they need for you know, pay their employees and whatnot, is completely constant. And then we go actually institution type by institution type, it's very constant. Now there's a little bit of elasticity that the market provides, but it's so we look at that by behavior, if you want. You see, yeah.
Okay. So if we don't have more comments, then I think we should call it a day. And I thank you all very much for attending and look forward to seeing you all tomorrow.
Great. Thank you very much for organizing. And thanks very much, John, for reading 2 long papers. Yeah, very carefully.
Especially
and
given the orthogonality condition.
getting a new version over the weekend, that was special.
I did a special bonus for you. Yeah.
All right. Thanks a lot. Thanks.
Great. Bye-bye.
Thank you.